The Black wealth gap is widening. We're discussing real tools and strategies to tackle it. This is about control. Education today to make a real difference tomorrow. Hire your kids to save on business taxes. Hi, welcome back to another episode of Black Wealth Empowerment. I'm your host, Leslie Batson of Rebel Rock Wealth, and I'm joined again today by Jamie Coleman and Shay Dobson from Compass Tax Advisors. Hi, ladies.
Hi, Leslie. Thanks for having us again.
Of course, welcome, welcome. So I love all the business and tax advice that we're able to share for business owners. So we covered a great tip in the last video. Today, Shay's going to share another great tax tip. This one has to do with our kids, right, Shay?
That's right.
Okay, so please explain.
All right. So hiring your kids is one of my favorite strategies because it allows you to move income to a much lower tax bracket and still accomplish the same things as far as taking care of your children. So right now you are buying diapers, school supplies, extracurricular activities, and the list can go on and on for the benefit of your child. And you're using after tax, your higher income tax after tax dollars to fund these things. Now, when we talk about hiring your children, you have to think about, of course, your industry and what they're able to do within, your business, because the IRS looks to, a reasonable job and a reasonable salary for that child. So it's a lot of creative types of jobs that you can implement for your child. I've hired kids as young as 6 months in a business for one of my clients. So it is a lot of creative ways. Now, when you hire your child, what you try to do is, when we talk about the reasonable rate right now for 2019, because we're in the 2019 tax season, the standard deduction amount is $12,400. And so the $12,400 is really like a benchmark that we want to use when we think about the salary for our child. Really don't want to go above that when we're thinking just basic level hiring our children. So I like to explain this strategy with an example. So let's just say we have a dentist that owns her own practice, and she has a 12-year-old who is a social media junkie, right? So, and this dentist, she wants her practice to grow on social media. She wants a social media presence. So she said, well, my daughter's a social media junkie. Let me hire her in my dental practice to do some social media marketing for me to get some presence out there. So now this daughter is, writing posts, for this dentist, and she's actually good at it. So, you have to think about what's a reasonable wage for that. And I'm just saying here, let's say, for example, that reasonable wage is $12,400 for that daughter for that year. Mm-hmm. So she pays her that $12,400 standard deduction. So what that does is, when the child files their tax return for that year, you have $12,400 in income, and then you have a $12,400 standard deduction. So what does that do? Zero out. So this child is paying 0% income tax because they have zero taxable income. So now this parent, of course, the income that you paid that child, we have to open up a custodial account. And so you as the parent will be on that custodial account, and that income or those wages are paid into that custodial account by direct deposit, or whichever way is, best for you. So now what you're able to do with that $12,400 that you've paid that child, now you can pay for the extracurricular activities, the after school care, the clothing, anything for that benefit. Now you can use with 0% tax dollars versus, let's say, your higher income tax bracket of 25%. So let's talk a little bit more about the savings. So this will essentially, of course, allow the zero tax funds. And so let's assume the parent is in the 25% tax bracket. So parent will save $3,100 in federal taxes using this strategy. And let's say it's a 6% state income tax rate. That's an additional $744. So on the federal and state side, there's $3,844 in savings. So just by hiring your children or hiring your child to do something reasonable within your company, and now you're able to use those funds for the benefit of your child. Now, let's see here. So let's take it a step further. So let's say that this child works as your social media administrator for a few years. And so you've been paying them this $12,400 for 3 years. So of course you triple those savings, because you're able to do this year after year. But let's just say that your social media has grown by leaps and bounds, and it's time for, you to give this child a raise, because it is in line with what they're doing. So now let's say we want to pay them above the standard deduction rate. So let's just say it's still $12,400, and then we want to pay them an additional $6,000 on top of that for their raise. Now we can still have a non-taxable event. So let's just say that the $12,400 on the tax return is still reduced down by that standard deduction, and you still have $6,000 left for taxable income. But what if we open an IRA for that child, and a traditional IRA, and move it over into, that IRA? So it's $6,000, I believe, for 2019. You're able to put back tax-free. Now, we're not opening this IRA for this child for retirement purposes, but we're using it as a non-taxable vehicle, as well as when this child reaches college age, we can withdraw from this IRA without penalty for a few reasons: first-time home purchase, as well as college expenses. So if we can all remember back in college, what was your tax bracket? Likely the lowest bracket that you ever will be in. And that's still a lower tax bracket than their parent. So you're moving this over into this IRA. And then once they reach college age, that could be 18, 20 something thousand in this IRA that they're able to pull from for college expenses, or even a first time home purchase in the area where they're in college. So let's just say we continue to pay this child the $18,000 for the next 5 years. So we have now contributed $30,000 into this IRA for this child. And so we talked about withdrawing without the penalty, which is awesome. And yeah, so
just a quick comment, a quick question though.
Okay.
When they do withdraw those funds from the IRA, they will not pay the penalty, but they will still have to pay the income tax, correct?
Yes, most definitely. So that's why I said that, in college, we're probably at the lowest income tax bracket ever, because
Right.
yeah, the child will still have to pay income taxes, but let's just say they're in the lowest tax bracket and it's a 10% rate versus the parent's 25%.
Right.
So you're still saving, a ton of taxes on withdrawing those funds.
Got it.
You've been able to defer it, because when you're hiring your child, they're still an employee, so you're expensing it from the business. So
Right.
each year that you're paying the $18,000, you're not paying any taxes on that money from the business, and then you shifted it over to your child, and there's no income taxes on it as well.
Yep. Love it. This is great. Okay, so Shay, if people want to learn more about this strategy and other tax planning strategies, how can they reach you?
They can always reach us at our website at mycompasstax.com. They can reach me via email, shay.dobson@mycompasstax.com. They can always give us a call at 850-273-7193.
All right, sounds great. Well, thank you, ladies. This was another great tax tip, and we will see you next time.
Thank you.
Bye-bye.